A very good afternoon to everyone present. This is Prasanna. I handle publications at MIDS. Let us take a moment to ensure our mobile phones are in silent for the next hour or so. Thank you. Thank you. A warm welcome to everyone present. On behalf of the Madras Institute of Development Studies, it's my pleasure to welcome you all to the MIDS Founders Day Lecture 2025 in honor of our founder, Malcolm S. Adiseshaya. May I take a moment to welcome the members on the stage. We have with us for today Professor M. Suresh Babu, Director of MIDS, and our distinguished chief guest to deliver this Founders Day Lecture, Dr. C Rangarajan, former Governor, Reserve Bank of India, and Chairperson, Madras School of Economics. May I now request the Director, Professor Suresh Babu, to honor our chief guest, Dr. C Rangarajan, as a mark of our respect and gratitude. May I now invite Professor Suresh Babu, Director of MIDS, to deliver his remarks and introduce our chief guest for this evening.
Good afternoon. Thank you. Well, I am not going to do the first part, that is to introduce our chief guest, because our chief guest does not need an introduction. But I will take a minute to talk about this memorial lecture and also to pay my respects to Dr. Rangarajan. Well, when I was initially thinking about this lecture, I had the opportunity to meet him, and then I requested whether he will be in a position to deliver the lecture, and he readily agreed. Sir, it is an honor and privilege for me to invite you to this very important lecture in MIDS calendar. Well, he does not need an introduction precisely because he is one of the architects of the economic reforms of 1991. That is only one aspect. But there are many, many aspects of Dr. Rangarajan which we know, like, numerous committees, numerous policy-making bodies, steering economic policy at crucial times when the economy was in real crisis at times, numerous advisory bodies, and above all, a scholar par excellence. People like me are his students who neither had the fortune to be, sitting in the class listening to his lectures, not in IIM, nor in other prestigious institutions where he taught, but we were all students of a different kind that we all learned from him in terms of his writings, his books, his lectures, and his, of course, the most recent book that has come out. So all of us, people of my generation, economists in India, have benefited immensely from just following and observing Dr. Rangarajan's writings and his works on Indian economy. And that is precisely why I say it is indeed a rare privilege for me and an honor to be on the dais with him today. Thank you, sir, for agreeing to deliver this lecture. Well, Founders Day lectures are also an occasion to remember the illustrious founder. I'm not going to talk a lot about MIDS and its founder, because we are an institution which is 55-year-old institution, have been in social science research field for decades now. But I would like to take this opportunity to bring to your attention that, well, MIDS over the last year has been working on the mission and the vision set out by our founder, Dr. Malcolm S. Adiseshaya. Well, research constitutes the core of the Institute's mission. MIDS places strong emphasis on disseminating its findings to policymakers, academic communities, and broader public. This is achieved through a combination of publications, seminars, workshops, and training programs. Just to give you an idea, during the last academic year, the Institute organized more than 35 academic events, attracting scholars, students, and practitioners within India and abroad. Through these dissemination efforts, MIDS continues to affirm its position as a leading social science research institution in the state and region. Well, in terms of some of our activities, I'm very happy to report to you that during 24-25, MIDS has published 5 books, many peer-reviewed journal articles, book chapters, government publications, popular newspaper magazines, working papers, occasional policies, policy briefs, and research reports. It's also important to note that all these were achieved by the support of our funding agencies, the ICSSR and the Government of Tamil Nadu. Now, I would also like to bring to your attention that our faculties have won various awards and recognitions. Professor Chalapati, A.R. Venkatachalapati won the Sahitya Academy Award. He also won the Ramnath Goenka Award for Excellence. Professor Hafsal won the RBI Scholarship. Professor Ajit Menon won Visiting Fellowships. Dr. Jafar won Best Paper Awards. Professor Venkatachalam won the Distinguished Alumni Award of the Annamalai University. So all this, I can go on with this list, but I just want to put it out here today, just to remind ourselves also and to reaffirm our commitment to the vision and the mission of our founder, Malcolm S. Adisheshaya. Well, I am not taking more time now, because today we have gathered here to listen to Sir, and that too on a very important aspect, the broad contours of India's monetary policy. We have so many questions and doubts and clarifications in our mind in terms of the current state or approach towards monetary policy. And I don't want to take much time between you and Sir in terms of listening from him on the broad contours of monetary policy. Sir, I welcome you to deliver the Founders' Day lecture.
Professor Suresh Babu and the distinguished audience, it gives me great pleasure and honor to deliver the Founders' Day lecture of this year. Dr. Malcolm Adisheshaya was a distinguished administrator, an eminent educationist, and also an economist. His career in the UNESCO is a shining example for others to follow. Above all, he was a humanist and a philanthropist. When he and his wife established the MIDS, they were emphasizing the point that in a widely dispersed country like ours, there is a need for regional institutions to study regional dimensions of the various problems. So, many people know that as an economist, he is deeply concerned with the poverty and inequality in the country and wanted policymakers to address those issues. But very few people know that Dr. Adisheshaya was also interested in the monetary and the financial system. In 1986, when the Chakravarti Committee submitted its report on the reform of the monetary system, a committee in which I was a member and played I think, an important part in formulating the conclusions. Dr. Adisesha wanted to have a meeting in the India International Center, of which he was in charge at that time. So he invited me, of course, Chakravarti, and a few others to discuss the conclusions. In his introductory comments, he made the point that while analysts of monetary policy discuss issues relating to price stability and growth, he wanted that the monetary and the financial system should also address the issues relating to poverty. Partially remembering that occasion, I am trying to address you today on the emerging contours of India's monetary policy. Monetary policy remains an important tool of economic policy, both in developing and developed countries. As the institutional environment changes, and the financial system changes, both domestic and global, the tasks of monetary authorities also keep changing. The monetary and financial institutions is far more complex today than before. The number of financial products that are available now have tremendously increased. In fact, the highly integrated monetary and capital markets that we see is also causing concern, because any problem arising at any one point can spread to others, and therefore, while the sophistication of the financial system is welcome, but we have to take note of the fact that that also can be, as I mentioned, a source of concern. The need for a central bank in India was discussed for a long time. Many committees had gone into it. But finally, in 1935, the Reserve Bank of India was set up. I will not go into that now, because that's a long story by itself. But the point is that the central banks in developing economies play a dual role. On the one hand, they play a developmental role, developmental in the sense in which we use here is developing the financial infrastructure that is needed in the country. And at the same time, they play a regulatory role. They have to regulate the financial system. So one would ask, which comes first? You have to develop the financial infrastructure, and then you can regulate them. But the point is that the development of the financial infrastructure is one part of the story, and the other part of the story becomes more important as the financial infrastructure develops. Now, the evolution of India's monetary policy, again, depends upon the pressing problems as they emerged. We are talking about the history of 90 years of the Reserve Bank of India. Therefore, in the early period, I think the emphasis was much more on the provision of credit. For example, the first plan document said, and I quote from the first plan, "Judicious credit creation, somewhat in anticipation of the increase in production and availability of genuine savings, has also a part to play." In fact, at that time, they used to adopt an expression, a non-inflationary deficit finance. But that was the feeling. But in fact, at that period, one thing happened. The governor of the Reserve Bank of India B. Ramarao resigned. Now, the letter written by Prime Minister Nehru to Ramarao is also in the public. It was not there for a long time, but now for some time it has been in the public. And Jawaharlal Nehru wrote to Governor Ramarao, and then he said, and then I quote, "You have laid stress on the autonomy of the Reserve Bank. Certainly it is autonomous, but is also subject to central government's directions." How do you reconcile? Monetary policies must necessarily depend upon the larger policies which a government pursues. It is in the ambit of those larger policies that the Reserve Bank can advise. Look at the word, advise. So that is the feeling, namely that the government has broader objectives, and within the broader objectives, you can advise. So this really created a situation in which the dominant role was, or the dominant partner, so to say, was the government. And so long as inflation was modest, this did not create a problem. Because you will know in the first plan period, the average rate of inflation, in those days inflation was measured only by the WPI, was 1.8%. And in 1960s, it was 6.2%. In 1970s, the inflation touched unacceptable levels, touching 2 digit level in 2 years. And the growth of money supply was high, and it was to be reined in. The 1980s, that was a period in which I came to be part of the policy making. In 1980s, saw a continuous correspondence between RBI and the Ministry of Finance on the control of inflation and the need to contain fiscal deficit, more particularly monetizing the fiscal deficit. In the 80s, the growth rate was about 5%, but the inflation touched to an average of 7%. It was at that time that the Chakravarti Committee was appointed, and we had long discussions, and as a result of it came out with some conclusions saying that reining in money supply is extremely important if you want to control inflation. And reining in money supply will also require a much closer coordination between monetary policy and fiscal policy. And they were, and the committee was not in favor of any scheme that automatically monetized the fiscal deficit. I mean, those of you who are familiar with the system would know that at that particular time there was a mechanism by which the deficit was getting automatically monetized. That was the system of issue of ad hoc treasury bills. One would think this is a very innocuous thing. What the rule said was that whenever the cash balances of the government of India fell below a particular level, then the cash balances will be brought up to that level by simply issuing a treasury bill in favor of the Reserve Bank. Looks very innocuous. But this essentially meant that whatever deficit that the Reserve Bank of India had will become monetized. Anyway, the early 1990s once again saw important changes in India's economic system. Far-reaching changes were put in operation, and by doing away with the system of issuing ad hoc treasury bills, we moved one step ahead in preventing the monetization of the fiscal deficit. The dismantling, I think people should know that many things could not be done because of a system which forced the rate of interest to be too low. The government securities that were issued were well below the market rate of interest. So long as the government securities were having a rate of interest which is well below the market rate, open market operations, which is one of the important instruments for controlling inflation, could not be used. And so long that you have an administrative structure of interest rate, you cannot use the interest rate as a policy instrument. So we dismantle the administrative structure of interest rate. Therefore, interest rate could be used as a policy instrument. By letting the government go to the market and raise funds, the government securities started having a rate of interest which is marketable, and therefore open market operations could be done. Then price trade liquidity and growth have always been remain the major objectives of monetary policy. The problem has been which is the dominant one and under what circumstances. Then I will mention a few things and come back to what are the key issues, and I will close up with some comments on the current situation. So then in 1993, that was my first year as governor, we introduced a system, we changed the exchange rate exchange rate system. Under the new system, the market determined the exchange rate rather than the Reserve Bank of India fixing the exchange rate. But of course we said at that time, and many governors have repeated the same thing, namely that we are not focused on any particular level of rate. We will intervene in order to reduce volatility in the market. But I think sometimes that clarity is not there, because when people say that why did you intervene in the market if we want to avoid stability? The word stability, I suppose, those of you who are studied economics will understand that the stability can be interpreted in many ways. Now, you can say the volatility, that's the opposite of stability. Volatility can be around a particular level, or volatility can be around a declining level. It is correct to say, as the governors have said, that we are not pegged on a particular rate. Please remember, what is the exchange rate now? And what was the exchange rate in 1990s? But let me tell you also what was the exchange rate of the rupee dollar when I was a student in the United States. So you go back to a longer period and you find that when I was a student, $1 was equal to 4.75 rupees. And it has now become 90 plus. I don't know, it might have gone down, they intervened, it might have gone down. So why and all that is a different time to speak. But the point really I was saying is that the exchange rate system was allowed to be determined by the market, but we thought that it should not exclude us if the market will always determine the exchange rate, but the Reserve Bank will intervene. There is enough time, I will talk about it later. And then financial stability also became objectives. The question really is, as we go, that there are multiple objectives. And to make a point on the change, recently the monetary policy, the Reserve Bank of India also was tied to a monetary framework, which is what we call flexible inflation targeting. I will speak about it presently. Now, enunciation objectives. What are the issues? Enunciation objectives is extremely important. And that determines what an institution will do. So if the institution is to be judged, there must be some objectives which must be accepted. So therefore, and the enunciation objective is extremely important from some another point of view. People talk about the autonomous nature of the Reserve Bank. If you want to judge the autonomous institution, then you should also know what is the objective with which that institution was set up. So the links must be understood. If you want to have accountability, then accountability needs a clear enunciation of the objectives. So thus an accountable central bank is one with clearly articulated and publicly stated objectives. That's the thing that will help. In talking of the objectives, I wrote in 1997, and the broad objectives, sorry, I am quoting myself, the broad objectives of monetary policy in India have been, one, to maintain a reasonable degree of price stability, and two, to help to accelerate the rate of economic growth. The emphasis as between the two objectives has changed from year to year, depending upon the conditions prevailing in that year and in the previous year, unquote. In fact, what I had said was a version of the Taylor's rule in its most discretionary form. So, the question is this: the choice of a dominant objective becomes relevant when there are multiple objectives which are reasonable and appropriate for an institution. So but in the literature on policy analysis, there is also one phrase that is used that is called the assignment rule. Given a number of tools and given a number of objectives, which tool is most effective in terms of the objective? All the objectives may be the objectives of all the policy instruments, but you must find out which instrument is most appropriate to achieve which objective. It is from that angle the maintenance of price stability becomes the dominant objective of monetary policy. Why is this an issue? This becomes an issue only because of the fact that there is some conflict between the objectives. If price stability and growth can be achieved at the same time at all times, then there is no problem. I mean, I think there is because there can be a conflict between the objectives, if not at all times, but at least on occasions. Therefore, you need to define what the dominant objective is. On price stability and growth, students of economics will know there has been a lot of discussion on what is called the Phillips curve. The Phillips curve really related the wage rate to unemployment. Now we are shifting it a little to price stability or price inflation and growth. So the idea is that is there a conflict between the two? The Phillips curve showed that there is a conflict. And sometimes even you hear people saying, why don't you have a little more inflation, let us get a higher growth. Therefore there is a trade-off between the two. But the literature has a detailed analysis of the Phillips curve, and people have argued that at best there is a short-term trade-off between the two, But in the long run, there is no trade-off between the two, and the line will be vertical, and therefore it is not appropriate. So, well, there are people who have discussed this in the literature a lot, but this takes us to the other question. Whether one can really talk in terms of threshold level of inflation. Is there a level of inflation beyond which it becomes a hindrance to growth? So that is the concept of the threshold level of inflation. It is, in fact, difficult to estimate, but theoretically we can understand that at certain levels of inflation, growth may not be affected. But once you cross the threshold, then it leads to, it begins to affect growth. So people started talking about threshold level of inflation, and I think that I also talked about it much earlier on the threshold level of inflation. Concept-wise, the threshold level of inflation is understandable, but empirically, how do you arrive at that number? It is this concept of threshold level of inflation led to the idea of inflation targeting. Inflation targeting is essentially to put before the central bank an objective saying that control inflation in such a way that it does not pass beyond a particular level. It was first used by the Reserve Bank of New Zealand in 1990. Since then, 28 other countries have adopted inflation targeting. United States has not adopted inflation targeting as a statutory prescription, but essentially it also follows an inflation targeting, saying that in their opinion 2% inflation is what is the level. I mean, and I think they should not go too much beyond it. I think before I go to inflation, I must also tell you that what is the price level that you are looking at? When we were part of the policy making framework, the only index that we used to get very quickly is the wholesale price index. In fact, all discussions up to about a decade and a half before is all in terms of what is happening to the WPI. We know WPI is not, the wholesale price index is not the ideal one, and what is needed is a consumer price index. So now we have shifted. But why we did that? Because the data was not available. Now the whole idea was that central bank should have some like a North Pole, a North Star, and the North Star is what the inflation target level should be. How to derive it is another issue. But the point is that the inflation targeting, either in a formal or an informal form, came to be accepted. In fact, there is an interesting quote that I will give you. Writing before the crisis of 2008, good friend had titled his essay as, the title of the essay is, How the World Achieved Consensus on Monetary Policy. In fact, he wrote, and I read out the few sentences, the spread of explicit or implicit inflation targeting has demonstrated its virtues. The new working consensus on monetary policy has helped to reduce the volatility of both inflation and output. But this confidence got broken in the 2008 financial crisis. But nevertheless, the idea of having an inflation target. Now, what are all the elements that should be there? There should be a target. And should the target be a 1 point? Or there should be a range within which it can fluctuate. So these are all details which become an essential part of the flexible inflation targeting. The present flexible inflation targeting framework in India has a mandate for monetary policy to manage inflation at 4% plus or minus 2% is ending in March 2026, and people have been asked to give comments, and the discussion paper has also been prepared by the Reserve Bank. And I don't see where Bhanumurthy is. Bhanumurthy and I have written a paper on this in inflation targeting, flexible inflation targeting. Now let me pose some of the issues that arise, and two or three things. What are the big issues? One, what do you mean by inflation targeting? What inflation? Some people talk about saying that don't focus on what we call headline inflation, that is taking everything into account. Focus only on core inflation. That is, core inflation is the general increase in the price level less the increase in food prices. In the US, they exclude the oil price also, because they say it is volatile for other reasons, therefore we don't do it. Then the question is, the key and important question is, what is the acceptable level of inflation? And then thirdly, a question that arises is, these are the three questions that we address in our article. The one is, what is the flexibility that you have? So remember, the framework itself is being called flexible inflation targeting. We are not saying that you should always maintain X, like 4%. We are saying 4% is the level at which you should be over a long time, but you can fluctuate between 2 and 6%. Now, I will briefly answer these three questions that I mentioned, and that is first of all, inflation control by itself is important, in the sense that there are difficulties faced by the economy and the society when the inflation level is high. It is all right for people who are very rich, or people whose salary is indexed to prices. It doesn't hurt. But for people who are poor and whose salary or emoluments is not fixed to their price level, suffer a lot. Therefore, I think Manmohan Singh used to say that the biggest anti-poverty program is to control inflation, because that is the way in which it becomes important by itself. And also there are other problems with high levels of inflation. It affects savings, because if the system is not stable in terms of price stability, then people will say, why should I save now? If I save now, what I save now is not going to be equal to what it is today because of inflation. And in the case of investment also, what happens, this misdirects investment into speculative activities. So for all these reasons, by itself, there is a reason to control inflation and keep it at a level which doesn't go beyond what may be determined as acceptable level of inflation. What is the target? Headline or core? Headline inflation is what we mean by general price level, including all commodities. Core inflation is price level excluding a few commodities, and more importantly in India, the food inflation. The argument to exclude food inflation is twofold. One is that the major one is really that monetary policy influences economic decisions by controlling demand. And in food inflation is largely a result of supply shocks, because the monsoon fails or something happens, and therefore food output goes down, and then since food demand is a primary demand, its price will go up. And therefore monetary policy is not in a position to influence the food inflation, and therefore you should not use it. But this argument is valid on the surface, but if you look a little more deeply, you will find the situation something different. Assume food prices rise. If the income of the people remains at the same level, what will happen? When the income of the people remains at the same level, since food you think is basic, therefore when its price goes up, then as a result less income is available to buy other commodities, and therefore what should happen? Actually the other commodities price will fall. So people do not really understand this problem that way. That is, if the aggregate demand remains at the same level, there can be no change in the general price level, there can only be a change in relative prices. Food prices will go up, something else will go down. So this is the critical point which people overlook. Now this is essentially pointed out by Milton Friedman. Milton Friedman may not be a very popular economist in India, but he's certainly a very sharp fellow. As somebody said, that you cannot defeat Friedman in his presence. So he's such a scholar. I mean, I remember him, meeting him when I was a student. As Milton Friedman famously said to the Indian audience in Mumbai in 1963, and I quote from him, "If the government is committed to a full employment policy, it may, in response thereto, expand the money supply by printing more money for government expenditure or for other purposes." The next sentence is important. "In that case, it is true that the upward push in wages produces inflation, not because it was necessarily inflationary, but because it happened to be the mechanism which forced an increase in the stock of money." What happens? When wages go up, the government has also to increase the wages. And if its hands are tied, then it pushes the central bank to expand the money supply, and it is that money supply which leads to the increase in the price level. Therefore, it is not just food prices that is that is responsible. And I wish also to point out that just imagine that there is food inflation. Supposing when food inflation is present, the government, with the aid of the Reserve Bank, expands liquidity in the system. Then automatically the food prices will also rise. We may not all be followers of the quantity theory of money. I suppose the quantity theory of money, which is maybe regarded as old-fashioned, but certainly it has a grain of truth. That namely, the old Fisher-type inflation, Fisher-type quantity theory of money propounded that when money supply increases, there is a proportionate increase in the prices. That is where the problem is, the word proportionate. But when money supply increases, certainly the prices will also increase, not necessarily proportionately. So the point is, we find that the idea of excluding food inflation is not correct. There is also another reason, because the food inflation must be taken into account the fact that an overall increase in price level does affect the poor. So therefore you cannot exclude that. And the other consequences of inflation, which I mentioned earlier. We do find that we plotted the movements in prices and with the growth. It is there in our article. You find that what fits the data is a quadratic equation which really goes like an inverted U. That is, at low levels of prices, price levels or inflation, growth increases. If it goes from 1 to 1.5 or 1 to, it doesn't affect growth that much. In fact, it facilitates growth. Then it reaches a level and then it comes down. So that is that is something that says that there is similar. There is we can postulate that inverted U is the kind of relationship that you will find. Of course, there are people who do not agree, and there are people who define it. The relationship can be explained by various other equations and so on. But a broad understanding of the relationship or the plotting of the numbers do indicate it. And I will come to the next point, which is what is the acceptable level of inflation? The point is that the acceptable level of inclusion, as I mentioned to you, by plotting, you get somewhere near 3.9 to 4% inflation. The point is, the Chakravarti Committee used the term acceptable inflation. They addressed this issue, and the number 4% as the acceptable level of inflation is in the 1985 Chakravarti Committee report. And under the sentence, I can't get this sentence here, but it talks about the acceptable level of inflation is 4%, which is necessary to accommodate the shift of real resources from sectors which are not necessary to sectors which are necessary. I think somebody might say it is opaque, but I plead guilty to that, in a sense that I believe I might have written it. And the point really is that looking at all the data, the 4% inflation looks acceptable, and I think there are many other ways of doing it. Just not look at the data like this. Dr. Bhanumurthy has, for example, simulated the model that he has for different levels of inflation and studied what happens to growth under these circumstances. And he also comes to the conclusion that the point of inflection is estimated at 3.98. So this will remain a contentious issue. I mean, there is no absolute way of saying that this way of estimation alone shows. But I also want to say this. The acceptable level of inflation in the West is 2%. And if you keep the acceptable level of inflation at a very high level, you must understand the impact of this on the exchange rate. The purchasing power parity theory essentially said that the external value of the currency is determined by the internal value of the currency. So if you have a level of inflation which is very high, as compared to your competitor countries as well as to the countries to which you export, then to that extent exchange rate will be affected. But I will come back to one point very soon and say that purchasing power parity theory does not hold good in the present when capital flows become important. Now, the last point is inflation band, and I think this is not such a critical issue, but the idea that that certain flexibility must be given to the central bank of the country is behind it, whether it should be only 4% plus or minus 1%, or which it should be 4% plus or minus 2%, is a matter of judgment. But I think this gives enough flexibility for two reasons. One, that all fluctuations, the movement of the general price level or the movement of inflation may not necessarily be in one direction. It may go up, it may go down, and therefore we should have flexibility. The flexibility on that account. Second is that the point is that the monetary policy actions also do not immediately bring about the change that the monetary authorities want. It always takes time. Therefore, for two reasons, this flexibility is required. So I think this is 90 years of history. And I think it is important that the monetary authority have this special responsibility to monitor, assess, and take appropriate action to control inflation. Therefore, I would say the flexible inflation targeting is a good balance between the two objectives of growth and price level. It takes care of the need to control inflation beyond a particular level, and it takes care of the need to see that growth is not affected. I want to conclude on 2-3 points. We hear about raising the rate of interest and lowering the rate of interest in order either to control inflation or in order to stimulate growth. But in taking a decision to raise or lower the policy rate, RBI, or for that matter any central bank, must have a clear understanding of the impact of a change in interest rate. In fact, the quantum of impact that a change in interest rate will make on the economy. So by how much, if you raise the rate of interest, what will happen to the economy? Even before that, there is another question, which is, what rate of interest is the focus of the central bank? Is it the short-term rate of interest, or is it the long-term rate of interest? Keynesians argue that the most critical rate of interest is the long-term rate of interest. According to the whole Keynesian framework, if the long-term rate of interest goes down, it stimulates the investment. Investment through the multiplier process affects income and output. Now, fine, but does the central bank of the country operate or directly affects the long-term rate of interest? For example, the policy rate in India is essentially a short-term rate. It is believed that the interest rate will, a short-term change in the short-term rate of interest, if the market is well integrated, it will also affect the long-term rate of interest. It depends upon the integration of the market. So that is what Keynes said. But Hartley said that it is a short-term rate of interest which is important, because his argument is that when the short-term rate of interest goes up, the company reduces its stock holding. And when the stock holding is reduced, that is what we call inventory. When the inventory comes down, then availability increases, and that affects the inflation. That it controls the inflation. So the whole, therefore, we need to have a clear understanding and studies in India. How does the rate of interest affect the economy? Does it work through the short-term rate, or does it work through the long-term rate? As I said, if the money markets and the capital markets are well integrated, this may not be an issue. The short-term will produce the impact on the long term. This led in the United States during a period of the early 60s and so on and so forth to a doctrine called bills-only doctrine. The bills-only doctrine said that the Federal Reserve System will operate only in treasury bills. They will not operate in long-term securities and all that. So that essentially meant an underlying highly integrated money market and capital market. But that failed. Therefore, they had to abandon the bills-only doctrine. And in the 1960s, there was also another thing that they tried to do. That was move the short-term rate of interest in one direction and long-term rate of interest in the opposite direction. Do you know what it was called? It was called Operation Twist. You might have heard of the dance, the twist dance, that you move one part of the body in one direction, the other part of the body in the other direction. So that also failed. So I believe that we need a lot more of studies in order to be able to understand how the rate of interest affects. Some people think only in terms of long-term investments like housing, it affects more. So therefore the issue that I point out is that it is important to look at how the interest rate affects. Theoretically we know how, but I think what at the empirical level. Let me conclude by two comments. One is the way in which monetary policy instruments influence the economy. There is Okay, there is an asymmetry or asymmetry in the way in which the monetary policy instruments affect the system. When the monetary authority wants to control inflation, they can raise the rate of interest. When the central bank raises the rate of interest, it affects the system immediately. But when the central bank wants to lower the rate of interest, as we are doing now, then it wants to stimulate growth. But the asymmetry is that when the central bank raises the rate of interest, its impact is felt much more quickly than when it wants to lower the rate of interest to stimulate growth. So that is the real the asymmetry. That is why one economist, Tarshis, in his book, which was popular in our days, when he said, the monetary system has efficient brakes, but the accelerator is uncertain. So it is exactly what you would say that we can take the horse to the pond but cannot compel it to drink. We can lower the rate of interest, but if there are other reasons because of which investment is not happening, it will not. So in the present situation, I think the policy is correct, what the monetary authority is doing is correct, but we need to go beyond interest rate in order to be able to understand why private investment is not picking up, and we must analyze the problem both at the aggregate level and at the sectoral level. The second point and the final point that I wish to make is, what is we essentially talked as if there are two objectives, price stability and growth. I did mention about exchange rate, I did mention about financial stability. But there are occasions in which some of these other objectives also can take dominance. Therefore, the question that is happening, what would one ask the question, right? We have a situation where the inflation is low, the growth is picking up, but at the same time we are witnessing a situation in which the exchange rate of the rupee is falling. Now what can be done? Now I would say that as I mentioned earlier, RBI governors, all of them have mentioned that we are not focused on any particular rate. We will only intervene in the market to reduce volatility. This is correct, but sometimes I think a better explanation would be required, and say that when we mean by volatility, we mean not only volatility at a particular level, even if we are willing to concede that the rupee has to fall, but we would like to make the fall in the rupee somewhat steady or not so sudden and give a jerk to the economy. I think that is also a reason for intervening in the market. And the exchange rate today is determined not only by the current account deficit, but also by capital outflows. Therefore, when we look at the fall in the value of the rupee, we must also try to understand what is really hitting it. I'm sure that very soon that it can happen, but the current account deficit may also rise, and that can also influence the exchange rate. But right now what is happening is the capital outflows are happening. Many institutional investors abroad are selling the shares in India and repatriating the money. Now this is a capital outflow. Now in normal situation you would say, you will go and find out why this is happening. is there something wrong with the Indian economy or not? But in the current situation, we can't say that. The Indian economy, on the broad parameters, is doing well in the sense that growth is adequate, or I mean, can always be better, but growth is there, and the inflation level is low. So what is happening is essentially because of the fact that the American president has imposed a tariff rate of 50% on our exports to the United States. Now this is something which has nothing to do with economics. I mean, it has something to do with weaponization of tariffs or geopolitical considerations. So in this situation, I would say that we really need to shift the attention to coming to a quick resolution of our problems with the United States, because it is not a purely economic consideration that is driving what is happening there. So therefore, first let me say that we need to go beyond interest rate in order to influence the economy and let the private investment to pick up. As far as dealing with the exchange rate is concerned, while we can use the reserves and bring down the exchange rate as it has happened in the last 2 days, but the final solution to that lies also in the diplomatic arena. Let me conclude by saying, somebody said central banking is neither a science nor an art, but a craft. I say this is half truth. Central banking cannot become a craft. It is central banking is no longer applying well-known prescriptions to well-known problems. Neither the problems nor the prescriptions are completely clear. So, in this situation, what is the role of rules? There is a long discussion in the literature on rules versus discretion, which applies not only to economic problems but also to other issues. Therefore, while what I would say is that rules help anyway, and rules can also be rigid and inflexible. So we need to have rules, but the rules must be flexible. And that is why what we need is not rules versus discretion, rules and discretion. And this is sometimes also called constrained discretion. So what the kind of monetary system that we should have belongs to the category of rules and discretion. Thank you very much.
For delivering the MIDS Founders Day Lecture 2025. It's our privilege to be a part of this audience today. I would now like to invite our Director, Professor Suresh Babu, for his concluding remarks.
I think we can take a couple of questions if there are any very urgent pending questions without much of long questions, very brief questions, then perhaps we can take a couple of questions.
You were referring to an important point about US tariff, and there should be a quick resolution as far as this issue is concerned. Could you please elaborate on that, sir? Why India should have a quick resolution on US tariff? And
no, what we now describe it as a tariff war is essentially that the President of the United States has taken the view that as if that United States is a victim. So he propagates the idea that we have helped all the other countries and for so many decades. Now that is why we had current account deficit. Now we will now retaliate and levy tariffs. Now you remember in the tariffs there are two parts. The first part is 25%. The second 25% is totally political. The second 25% is that we want Russia and Ukraine to come to an understanding, and if Russian ability to fight the war is restricted, then it will be better, and therefore all those who trade with the Russia should stop. Then Russia will not be able to export, therefore its resources will be limited. So these are the considerations on the basis of which it is done. In all cases you will find that not all countries are affected in the same way. I think India is one or two countries for which this high level of 50% has been levied. That many others come around and agree and reduce, and agree to what the president says, and then the rates are taken away. But look at Canada, for example, the neighbor of USA, and they all used to say about the fact that the longest undefended border is between Canada and United States. So the whole length, there is nobody monitoring there, any military, any police, nothing. But even that has become, that country is also in great, in difficult situation. So I'm sorry that the WTO, in a sense, has become a dead institution. It is the role of WTO, which is supposed to establish a trading system which is universal, that it is not discriminatory, and so on. But for various reasons, WTO is not in a position to operate. So everyone is articulating. It all depends upon how long this kind of an impasse can be continued. But each country is also trying to get better of the other and somehow come to an understanding and not raise a general issue. Let us wait and see. But I hear every now and then saying that the pact between India and United States is coming to a close and all of that. And even President Trump also says that. But we just don't see it. So I would say that it's critically important that somehow, it's always a matter of give and take, and what to give and what to take is the issue. So you will have to do that. That's the only way.
Sir, will internationalization of rupee will make RBI's monetary policies less effective in controlling inflation?
Internationalization of rupee, will it make monetary policy less effective?
In controlling
No, I think that's not true, because internationalization of the rupee, assuming that happens, I'm not very sure that it is going to happen in the near future. I think we can move towards that thing, but I don't think that's it. But internationalization of the rupee is essentially what it means, that currency is a hard currency. The hard currency is a currency which is convertible at all points. Now, sterling is a hard currency. So that doesn't mean that the Bank of England has lost its control over monetary policy. No, that's not, the two are not related. It essentially means that when the central bank makes its monetary policy, it should also look at the global situation. I think you cannot, once rupee becomes a hard currency, then it is not possible just to look at only domestic situation. You will have to look at the global situation.
Professor Rajalakshmi, I would like to ask you one important thing. That is, we have been talking about how the Indian rupee, the value of Indian rupee is going down. What you stated from 2 rupees equivalent now nearly 100. But whether a common currency in Asian side, like Euro, in Asian side, there is a talk about it. Whether there is a possibility, and that may be the solution for that. I want you to put your no turn to it.
Common currency for Asian region, like the euro, a common currency for Asian countries. Is it possible? What are the possibilities?
You see, let us look at it. What is, if a currency is to be internationalized in the sense that it has, the convertibility is the most important thing, and whether we are at this particular point ready for a total convertibility. We are not willing to, we have all been saying right from the day I said about the exchange rate regime that we will allow the rupee convertible only on current account. We will not allow rupee to be convertible on the capital account. But capital account convertibility essentially means that anybody can take the rupee outside, anybody can bring in the currency and so on. That we are not, our situation is not that strong to make that point. And whether it is necessary also, I do not know. I mean, what are the advantages of internationalizing the currency? Now, when you talk of euro, euro is not the currency of one country. Euro is the currency of the West European countries which all come together and use it. Therefore, the problem there is the weaker nations versus the stronger nations. I mean, when Greece ran into problems because of the fact that the euro was strong, then they did not want a strong currency, they wanted a weaker domestic currency. So that problem arose. But the point is that they are more or less equal countries in terms of strength, whether it is UK or France or Belgium or Holland. I mean, they are, and they find it advantageous to it. I mean, there is an organization called Asian Currency Union, ACU. I mean, I think we settle, and I have attended many meetings of that. Therefore, we in order to minimize the use of hard currency like dollar, ACU met and settled it amongst themselves. Therefore, it made less demand on the hard currency like a dollar. So these things are happening, but to make rupee a currency which is convertible fully in all dimensions, I don't see it now.
One last question. There are many hands, but I think all good things have to come to an end. So we'll take one more question. Anyone? Yeah? Okay. Yeah, please. Can you pass the mic?
Hello, I am Arogya Swami, Senior IAS Officer, retired. A product of St. Joseph's College and Loyola College, where Honorable Governor studied on both. I have a question. The canons of taxation say less tax and more growth. What are your views, sir?
Less tax and more growth.
Yeah?
Less tax and more growth. Is it applicable?
No, I think you're not talking about monetary policy. You are taking the discussion to another area. No, I think less tax and more growth is applicable in some situations, but it does not, because the people who aspire for higher growth also say that growth can come only when there is higher infrastructure, good infrastructure in the country. And a good infrastructure, whether it is transports or communications or anything, can come only from the public sector to a large extent, and the private also can come in. But the fact is that if the people expect the government to provide the basic infrastructure, then they also need resources. So you will have to look at it at what point you are going to say that, all right, reduction in tax will promote higher growth than taxing which is required for infrastructure. There is no standard answer to say the one is better than the other in all situations. I mean, I think we really need to look at the situation in which the country is placed, and at that particular point what is needed.
Yeah, I think we have to stop because there are many hands. I'm so sorry about this, but I think at some point we have to stop. So that's why, and I don't want to tax Sir quite a bit. So very, very sorry about this hard stop on questions, but thank you very much, sir. I don't have anything to say because we heard the art, we heard the science, and we heard the craft of not only policy making but also macroeconomics. And I'm sure my students here will have to go back and read the basics of macroeconomics again in terms of understanding the relationships. So many intricate relationships were actually explained so lucidly within a very short span of time. And that, I think, is the master class that we had. So after that, I don't think I should speak anything and then, spoil the beauty of that master class. Sir, thank you very much. It was indeed an honor and pleasure for us. It was a privilege for us to listen to you. Thank you so much for accepting our invitation to come to deliver this lecture. I also take this opportunity to thank our funders, the ICSSR, Government of Tamil Nadu, and the Malcolm and Elizabeth Adisheshaya Trust for helping us to organize this event. I also take this opportunity to thank all my colleagues, my faculty colleagues, as well as our administrative colleagues who have been behind this. So when we were thinking of looking at a hall where sir could come easily and things of that sort too, today when I can see when the hall is full and when there are no chairs, I think it is their hard work in terms of really seeing which is an appropriate place. Events, publications, administration, everyone worked together to make this a very successful event. Two announcements. One, we would like to publish this as the Founders Day lecture, so it will be available. And I would like to charge a nominal amount to raise some revenue from that. So please buy it from MIDS. It will be soon available. Two, we will also have the recording of this lecture in our YouTube channel. So you can go back and listen to that if you have doubts and clarifications after reading your Macroeconomics 101, right? So that is one announcement. Second announcement is that please join us for tea. We have tea outside, and please join us on this occasion for tea. Thank you very much. Thank you all for coming today and making this a memorable occasion. Thank you.